We didn't get to do this as we typically do at our December meeting in person, so I'm going to introduce our 2021 NAIOP board. That's President-elect and Treasurer John Grimsley with Highwoods Properties, our Secretary Maureen Callahan with Troutman Pepper, VP of Communications is Jennifer Kuntz with Pope and Land, our VP of Education is Greg Bowler with Transwestern, VP of Membership and Diversity is Suzanne Markley with Ryan. Our VP of Government Affairs is Annie Baxter with CBRE. Our VP of Philanthropy is Mike Wells with Highwoods Properties. Our VP of Programs is Amy Curry with Hillwood, a new member to the board in 2021. Welcome, Amy. Our VP of Special Events is Ryan Hoyt with JLL. Our VP of Sponsorships is Brandon Houston with Trammell Crow, another new member of the board for 2021, so welcome, Brandon. Our Chair of Mentorship is Blake Underwood with the Dillwig Companies. Our Director of Developing Leaders is Christine Curry with Seelig Enterprises, and our immediate past president is Jeanette Myers with Murphy Myers. And I want to just pause there and thank you, Jeanette, for all your hard work. It was a challenging, unprecedented year, and your enthusiasm, your commitment, you led us very well, and thank you for a great year. All right, I want to do one more thank you, which is to our sponsors, our Platinum and Premier sponsors. Thank you all for your support over these past 16 months. Y'all have been awesome. You can see the list of all of our Platinum and Premier sponsors at your tables on the table card, but I do want to take a minute and recognize our Platinum sponsors, which are Brassfield and Gorey, Fidelity National Title, Highwoods Properties, Majestic Realty, Mayberry Electric, Nelson, Ryan, Troutman Pepper, and Truist. And as we typically do at our meetings, we want to highlight one of our Platinum sponsors, and today I'll be highlighting Troutman Pepper. I'd like to thank Troutman Pepper for being one of our longtime Platinum sponsors. The firm has been a supporter of our organization and its mission for many years. Troutman has more than 1,200 attorneys across its 23 offices. The firm's real estate practice has been recognized nationally for its accomplishments in industry publications, including Chambers USA, the Legal 500, U.S. News Best Law Firms and Best Lawyers in America, among others, as well as here locally by Atlanta Magazine and Georgia Trends Magazine Legal Elite. We truly appreciate Troutman's continued support of NAIOP Georgia, and we're happy to welcome the firm's representatives who are with us today. Thank you, Troutman. If you're interested in being a sponsor, please feel free to reach out to Debbie Koenig, our Executive Director, or Brandon Houston, our VP of Sponsorship. So now a little bit of NAIOP business. We got some events to talk about, some in-person events to talk about. So we'll be having our annual August cocktail party in person, honoring Atlanta's top brokers, obviously in August. And so stay tuned for more information on that event. We're excited to have that. We're also excited to announce our golf tournament is back this year. We weren't able to have that last year. It has been scheduled. We have a date for that. It'll be September 13th at the Capital City Club in Brookhaven. I believe registration will open up sometime later this month. So be on the lookout for that. And then I want to obviously 16 months ago, we gathered for NAIOP night at the St. Regis. We were not able to do that this year. It's obviously kind of the real estate event of the year. It's usually attended by about 600 people, but also it's our main fundraising event of the year. And we're able to, with NAIOP night, we're able to give between $60,000 and $75,000 a year annually to the Ron Clark Academy. And we don't want to miss the opportunity to do that again this year. And so we're working on something that we're going to have in October that'll be kind of our main fundraising event. So please, Mike Wells is leading the efforts to plan that, and we'll have more information on that. But we'd love y'all's support with that event when we announce it. And so now I want to invite Suzanne Markley to come up and talk about our diversity and inclusion initiatives. Thank you, Suzanne.
Hey, everybody. Good morning. As Shep mentioned, I'm Suzanne Markley. I have been serving for the last almost 2 years as the NAIOP Georgia VP of Membership and Diversity and Inclusion. And I'm very excited to be with you this morning to not only tell you about our first annual summer internship program, but also I have the privilege of introducing you to 6 very bright and talented young CRE professionals. For those of you that have been sitting in this ballroom or one like it for the last 10 or 20 years, you already know that diversity has not been a hallmark of the Atlanta CRE industry. NAIOP Georgia most certainly recognized that, and about 2 years ago set out to create a program that would provide BIPOC students with both access and exposure to commercial real estate jobs. And hence our summer internship program was born. The program itself is simple in theory. NAIOP Georgia would ask for the commitment of CRE organizations here in Atlanta to hire interns from a pool of candidates that we sourced and vetted from local institutions like Georgia State, Morehouse, Spelman, and Clark Atlanta. Obviously, the devil is in the details, and taking that program from inception to where we are this morning took a tremendous amount of planning and coordination. But really, most importantly and fundamentally, it required our partner companies and participants to stand with us in saying that the status quo is simply unacceptable. Organizations hire interns to fuel their future growth and fill their talent pipelines. And the 6 companies that partnered with us in this program did so because they already know that a diverse and inclusive environment guarantees enhanced creativity, productivity, and performance. And that is how they envision their future. And as a shameless plug, if your organization is interested in participating with us next summer, you can see me for details. Once we had our 6 companies with us partnering, a NAIOP Georgia team, including Jeanette Myers and Shep Dinos and Debbie, and my biggest partner in crime, Greg Bowler, who should be standing right here, we got together and we interviewed 40 potential candidates. And so these 6 individuals that ultimately were granted internships this summer are wildly impressive. And I am so grateful that they took a chance on us because I know that you had your pick of the internship market. So thank you guys for being here this morning. And it is my sincerest pleasure to welcome our inaugural group of NAIOP Georgia summer interns. If you guys will stand as I call your name and just remain standing. Radut Agarwal, Atlanta Property Group. Jose Iturbe with Cousins. V. Nguyen with Transwestern. Jalen Russell with Ryan. Brennan Suttle with Regent Partners, and Shakori Valentine with JLL. Thank you, guys.
Thank you, Suzanne. So now we're on to our event. I'd like to start by thanking Amy Curry, our VP of Programs, and her committee for organizing this event. And I'm going to introduce Justin Parsonet, Executive Vice President with CBRE. Justin and the panelists, come on up. Let's get started.
All right. Good morning, everyone. Let's give it up for meeting other humans in person. Thanks to everyone for being here today, and it's so great to see you all again. Can't tell you how thrilled I am, and I know the panel is as well. As Shep mentioned, kind of things fell apart in terms of meetings in February. In fact, the last meeting like this that we had was in February of last year. Imagine how much has happened between then and now. And I thought you guys would get a kick out of this. If you don't remember, the title of that meeting was The Economic Outlook and What's Ahead for Commercial Real Estate by Heidi Lerner with Seville's. I can assure you, while I haven't studied her slide deck in detail, I know that a pandemic wasn't mentioned once within it. Neither was 15% unemployment, over $5.3 trillion in government stimulus and support, a complete emptying of the office sector, office buildings that is, and a total acceleration of a trend that was already happening as it relates to logistics in the industrial space. So a lot has happened in 16 months. So without further ado, I'd like to make some introductions for this panel of all-stars in my view. Starting at the furthest from me is Marshall Nevins. He's a managing director with Blackstone, and I'll skip all of their accolades as I know that they would prefer me to, but rest assured that each of these is highly accomplished. Marshall handles acquisitions for Blackstone here in the Southeast, and we've done some work with him recently. Next is Melissa Frawley. She basically runs the Wells office here for Atlanta and the region, obviously one of the largest lenders in the world. And next on the list is Tommy Lee with Trammell Crow, obviously a sister company of CBRE, and he handles basically all of the capital markets placement for the development entity. And then finally, Stuart Calhoun, who's a vice chair at CNW and helps lead the office and industrial practice for CNW for Atlanta and the Southeast. So just to kind of reframe it, we've got, office and industrial brokerage, we've got development, but capital raising for development in that perspective, one of the largest lenders across product types with Wells, and then of course, one of the largest private equity funds in the world, maybe the largest, with massive holdings across product types in commercial real estate, his focus being primarily on office. So really interesting sort of set here, and worth noting that two of these panelists traveled from New York City to come with us this morning, so very much appreciate all of you taking time and preparing for this, so thanks for your time. So getting into our topics today, obviously this is a capital markets oriented discussion, and there's plenty to talk about with regard to what's not only happened, but what is in motion and what we can expect to happen as we go forward within the commercial real estate industry. I may kind of start macro and then get micro and just talk a little bit about your view, and we'll kind of touch on each of you here with regard to how the Sun Belt is positioned in general, because I know most of you guys are regional in scope and primarily focus on the Sun Belt. And then specifically, how is Atlanta positioned as we come out of this pandemic and we've got an economy that's kicking again, and particularly in light of, as Suzanne was talking about, a larger focus on diversity and inclusion. So maybe I'll start with you, Marshall.
Well, thank you. Good morning. Thank you for having me. We believe the Sun Belt is very well positioned. And I think, the migration trends, the employment growth trends that we were seeing before the pandemic have, in most cases, only strengthened. And I think with that, sort of our belief that they are as well positioned as anywhere else continues. I am happy to say that places like New York, I think, are starting to show signs of life. So I don't know that our view is it necessarily is mutually exclusive for cities like Atlanta or cities like New York to be vibrant and growing, but certainly we are very optimistic about the growth of the major cities across the Sun Belt. Atlanta specifically, I think we are as bullish as anywhere else. I think, as I'm sure we'll talk about, what's happening in and around certain parts of Atlanta in particular is as dynamic as anything we're seeing anywhere else.
Great. Melissa?
Yep. I would completely agree. By the way, go Hawks. Did anyone watch last night? Yay! But super bullish on the economy here and the Southeast in general, of course. I don't think some places are coming back and it's not one or the other, but I think the entire pie is growing. I think Atlanta is extremely well positioned. We hear a lot about being competitive with some other cities around the Southeast, but we are so large relative to the other cities. We're really the capital of the Southeast, right? You asked about diversity, and we're seeing, companies, as we'll talk about, come here to, recruit more HBCU and university talent, and we have just such a plethora of that here. And so we're putting out a lot of money. We've closed more this year than I think we ever have out of my office here in Atlanta. So it's been very strong, and excited to continue to watch it.
That's great. Tommy?
Yeah, so it's good to see everybody this morning, and I've already got scolded for talking too fast once this. I'm going to do my best to slow it down. But I would say from a development standpoint, from a Tremel Crow, and a lot of my colleagues are sitting over at the table, if you just look at the size of our office, how it's grown in the last even 2 to 3 years, that probably is a good indication of how committed we are to Atlanta, and as it's a representation of the Sun Belt. Anytime a deal comes through on our company that's in the Sun Belt, I would say from a excitement or frankly an ease of use for me is to go find capital. It's always easier than what we're seeing up in the eyes or the nodes on the coastal sides, whether that's New York or the Seattles of the world. And I think a lot of that's just, it seems like there's just a commitment in the Sun Belt to be pro-business, to take out a lot of the restraints that come into play, and it also allows a lot of creativity that exists between what we chase is that spread between what you can get control of if you go and try to do assemblages or you try to get control through creative means and the exit caps that exist. So I think when you look at Atlanta within that Sun Belt for us, it's hard to ignore the fact that you have one of the biggest international airports in the entire country. You have great economic growth. You're coming out of a cycle that you've seen how Atlanta can emerge out of something like the Great Financial Crisis, and I think people are expecting that to happen again. So we're extremely bullish on the Sun Belt. We're extremely bullish on Atlanta, and I think it's really well poised to take off in the next couple of years if it's not already.
Right. Stuart?
It's been rewarding for me the last few years as an Atlanta native, and have spent my entire career in the Atlanta market. So for the last 20 plus years, I've been traveling around the country with my colleagues from other markets around the country, and we would travel in packs doing road shows, and we'd be, as Justin can relate, in New York and Chicago and Boston, the major capital markets. And for most of my career, when we would sit down in these conference rooms with large equity sources, like my friends on the panel here, they would want to talk about DC, they would want to talk about New York, they'd want to talk about Boston, and when we would get to little old me in Atlanta, there would be sort of this yawn, and people would get up to fix a cup of coffee and walk out of the room to go check a text. And really palpably in the last 2 years that has changed, and they really want to talk about the Sun Belt now, sometimes at the exclusion of the traditional equity draws of New York and Boston and so on and so forth. Now, I don't pretend that that's going to be a lasting situation where suddenly investors are going to pull all their money out of New York and DC and come rushing into Atlanta. But there's been a leveling of the playing field that I think really benefits everybody in this room, and I think is really here to stay.
That's great. Melissa, we'll start with a question with you as the majority of the capital stack in most of our deals. Obviously, we all participated and watched as things sort of melted down, and everyone went to their corners during 2020. Clearly, as we turned the corner into 2021, and there was sort of an understanding, sort of a light at the end of the tunnel, capital kind of came back in from a lending perspective. What's your view of where things stand now, not only at Wells, but across the lender landscape? And who do you see as most active in that space right now?
I mean, it's really everyone who is not active these days, right? I mean, the market is so liquid. Everyone is competing. We're seeing, traditionally banks played at the shorter term end of the the duration spectrum, probably in the, short term, less than 5 years loan space. But we're seeing we're competing with life companies, we're competing with debt funds, we're competing with, CMBS, we do that also. So it's just everyone right now. And it's as competitive as ever, which has caused, spread compression. We're starting to see some debt yield. We're cash flow lenders, so when we look at, loan sizings, it's getting more aggressive, and it's a little bit of, I'd say, certain product types, they're more in favor right now, than others are just extremely industrial, and multifamily right now are extremely, attractive and very, very competitive. So.
As you're looking across those product types and evaluating potential loans, what are the key kind of triggers that you're looking for in terms of risks? For instance, you're sizing up an office building. Around the kind of investment committee table, what are you guys really looking at and trying to pick apart and assess before making a loan and when you're pricing a loan?
Yeah. Great question. We're not seeing a lot of office asks, just as we'll talk about, not a lot of trades.
Don't remind me. Yeah.
I'm sorry?
I'm aware of that. Thank you.
Yes. It's a big question, right? And I've had office owners to say, nobody really knows, right? So, honestly, we're not seeing a lot of it, but I think that's probably a spot where we're a little less aggressive these days than on in some of the other property types. But we obviously are very sponsor-driven, experience and what has the sponsor done? How much of this have they owned? Their character, and then obviously the real estate itself. We look at the durability of the cash flow. Are they long-term leases? Are there credit leases and those types of things?
Tommy, kind of coming off of that, on the equity side, as you're reviewing potential developments and raising capital for that, I think we know where the biggest pools of capital are, but help us understand that and how that might evolve as we get into the next 6 months, year, and as you guys are thinking about the next wave of development for Trammell Crow.
Well, before I even get into the equity, I just want to make sure it's crystal clear. I agree with everything you said, given that we owe you billions of dollars. So the debt side's been great. On the equity side, not surprisingly, industrial is the place to be, right? And I think that if you ask me what it's going to be in 6 months, I'm going to say industrial again. A year, industrial. 3 years, industrial. 5 years, I'm going to say industrial. Because if you just look at the rent growth projection across the country, and especially in the markets that we're playing in, you can't ignore a macro movement in the economy, right, and how people are processing. And I think that if you focus on finding sites, what we're going to call off-market, there's always going to be some great opportunities in there in terms of what people are chasing and where they find there's a good risk-reward dynamic. But other places that you're going to continue to see interest is where multifamily's done pretty well during COVID, right? If you look at just how Trammell Crow handled the pandemic, we certainly saw a dip in terms of the capitalization, and we're going to call capitalization entering into a term sheet or a cost-sharing agreement with us in prospects of starting something a year later. We saw it could dip down to about $750 million in 2020, and that's due to the fact that we extended a lot of stuff, but we're already back to $1.4 billion this year in capitalizations. So a lot of that got pushed, and it wasn't just necessarily let go. And that's across the board in terms of industrial, multifamily, and I'll be the person to say it. We just did it for a spec office deal in the Southeast, and so hopefully that'll all close in the next couple of weeks. But that's on a lending front, that's on an equity front, and there's hope that I think is pushing us towards these other product types that are not just industrial. So multifamily will be strong. We are actually very strong believers in office in the future. I know there's a couple other panelists that believe in that as well. And I think you're going to start seeing some shifts into alternatives, right? People are just going to continue to chase yield, and people are going to have to monitor how that goes, because at some point, industrial cannot go to a 0% cap rate, although it's certainly trying right now.
There is a bottom, right? Please tell me there is.
There's going to be a trade up in the Northeast that's going to be sub 3. So it's, you start shaking your head at where can it really go. It's over the next 2 or 3 years.
That's a great tee up for a question for Stuart here, which is help those that are not as close to industrial understand sort of the perfect storm that's going on within that industrial space that is driving cap rates where they are and capital flow into it, and the difficulty of actually producing that product.
Well, look, there's clearly a global thirst for durable cash flow, right? For cash flowing real estate assets, not just value add assets where you can fix something and then flip out of it in a 2 to 3 year process, but something where you can generate really durable, reliable equity returns. And if you think about it, first of all, heading into pandemic, we were already in much of the world in a zero interest rate environment, right? So what's your risk-free opportunity to invest that capital? Pandemic hits and you clear 2 to 3 of our asset classes off the decks in terms of viable investment opportunities, hotel, retail, and so forth, leaving for the last year or so, while we all sort of tried to figure out what this means for us in the world, 2 asset classes if you want real assets and you want durable cash flow. Additionally, when you move into an inflationary environment, it pushes more money into real assets because they're hedges against inflation. And so you had all of this global capital getting forced into 2 asset classes that not only were sort of the last ones standing, but also were really outperforming. I mean, the performance of industrial and multifamily over the last year has just been phenomenal, and unlike anything we've ever seen in a downturn, which downturns typically sort of hit all asset classes to some degree equally. So it's really been just pushing this mountain of global capital into a very narrow hose, and the only outcome possible for that is reduced cap rates. Now, fortunately, the performance has been so good that as we are investing in these reduced cap rates, and by the way, I disagree, I do think we can hit 0 cap rates. But the performance of the asset classes has been phenomenal, and we are seeing, while you don't underwrite to the IRRs that you're necessarily achieving, right? We're underwriting to 6 unlevered IRRs, 5 unlevered IRRs in the industrial space right now. They're actually turning into 7s, 8s, and 9s because the sector performance has been so good.
Yeah, you mentioned one thing that I want to come back to, which is inflation, but zeroing in a little bit within that is the rising cost of construction, right? I mean, we've all watched lumber, and it's meteoric, rise, and then it's come back in a good bit. Steel's super expensive. Labor is in super high demand. Tommy, as someone who's trying to set a price and then project into the future for what value will be in a business where you sort of need to have your arms around price, how are you dealing with that? How do you manage that risk, I guess, is the best question.
Yeah. Oh, it's fine. Don't worry about it. It's
cap rate compression, right?
Cap rate
It'll
compression,
take care of everything.
rent growth, you'll be fine. No, I mean, it's a huge issue right now. So obviously lumber was the big focus in the first half of the year, and fortunately in the last couple of weeks we saw that tick down a little bit. So that's been at least heading in the right direction versus where it was going. But of course, as that's happening, now we're starting to see the steel really almost come to an inflection point with how quickly that's growing and pricing. Labor, we haven't seen the labor have the same kind of impact we saw back in 2017-18, where labor really took off, and it was a huge issue in a lot of the Sun Belts, particularly in areas like Phoenix and Atlanta to a certain extent. But it's something we have to be prepared for, especially on the development side. The idea that we're going to go out and engage capital and try to engage them at a pre-development stage with the idea that we're going to be delivering something in the future or locking in a GMP months from now. It's probably one of the biggest pieces of feedback I have with all of our offices around the country is when a package comes in, you got to be able to articulate down to a line item how you are accounting for potential escalation and what the methodology was to produce that, and make sure that there's enough in there so this way we're managing that budget. Because right now we'd rather make sure we're underwriting to the proper yield on costs when we go to start delivering than have a budget bust and suddenly you could be upside down having to recap a deal within 30 days of closing. And that's, fortunately for us, we do it so often, we have enough experience, we know how dangerous that position can be in. But when you see these commodity prices taking off, sometimes it puts us in a position where even with that escalation built in, it's surpassing it. And frankly, it's forcing capital to be a little bit more flexible and really start to lean in on how has the underwriting changed in that 6 months where maybe there was more cap rate compression, or maybe to Marshall's point, you're starting to see some rent growth that you can go put into your model to make sense. But it's tough. It's not easy to manage.
I bet. So we, as a subset, as we touched on, inflation in general, bigger topic than just one, construction materials, but inflation within the economy. real estate generally is thought of as a hedge, or at least a sector that is in a position to weather it probably better. It's not perfect, but it certainly can weather it. What product types within that space do you guys see as most well positioned to take on inflation and to essentially adjust with those rising costs? Anyone who might want to take it?
I would say properties with the ability to reprice, right? Hotels, apartments, shorter term leases where you can reprice that and not have the, locked in a 15-year lease. Where, yeah.
Figure out how many times we can say industrial today, but I mean, it's, everybody in this room saw a couple years ago where there was an inflection point with everybody always wanted long-term leases. And then you were rewarded for long-term leases of 7, 10, 12, 15 years. The irony now is you get better cap rates for short leases because of that ability to reprice in 3 to 4 years because there's going to be this influx. So talk about the best hedge. It's you're repricing off of massive assets with larger projects.
Right, and I guess of the product types, and rather multifamilies, most well positioned, right? In that it prices every month or every 6 months, and can best keep track with that. Hence the flow of capital into that space as well. Talk a little bit about the impact of COVID on space use, and I know that that's kind of hot topic. We're still ramping into utilization of office space, and lots of headlines right now about companies beginning to firmly nudge folks back into the office. But I think there's generally acknowledgement that the way many large users and small users alike use space may evolve. And I know you mentioned being very focused, Marshall, on the way space is designed. And as you think about the evolution of space use, how might COVID impact how tenants think about their design of space going forward?
Yeah, I will say I don't know that we pretend to know the answer yet.
Right.
Candidly, I think it's something that we talk about quite a bit, and we're always eager to hear others' thoughts. But from our perspective, I think the jury's out, frankly. Our focus, again, has been more around locations and assets and environments that we think will help companies attract people back to the office in an environment where many folks probably have come to enjoy at least parts of having more flexibility. And I think some companies or some segments of firms will perhaps offer more flexibility going forward. So if you either are trying to bring folks back and or make sure that when they are together, it's as productive as it can be, I think there are certain environments, certain buildings, certain layouts that foster that. But as it relates to the net impact on the usage of space, I don't know that we have a firm view. I don't personally think that there will be probably a net incremental demand for space. Perhaps it's neutral, perhaps it's slightly reduced. But again, I think in our view, for the right assets in the right locations, there could be even more demand as companies think about the ways that they bring people back together and then ultimately are as productive as they can be when they are together.
Yeah. Stuart, kind of shifting towards the logistics space, it's fun to watch Amazon and its growth over time and their voracious demand for space. Help us understand how not just Amazon, they're easy to point to, but other large logistics-oriented companies have sort of changed the landscape within the industrial space.
Gosh, well, I think a lot of what is going on with pandemic is we're just accelerating trends that were already sort of evolving, if you will. One of the most notable trends in the industrial space, and maybe this is new and directly related to pandemic, is we had worked as efficiently as possible towards a world of just-in-time manufacturing, right, where you want the shortest amount of time from the manufacturing facility to the end user of the product, right, and so. And what we've learned through pandemic is that really doesn't work for our global economy across all sectors, right? That we do need safety stock in these buildings that will allow for 2, 3, 4, 5, 6 weeks of supply chain shutdown. well, you know, in a 1 million square foot building, that's quite a lot of stock. So I think that in addition to the e-commerce space, that is just a global change in the sector that is creating net new demand on top of the dramatic acceleration of e-commerce, right? And we don't go into a building anywhere anymore where there's not some space in the building that is dedicated towards B2C or B2C direct, get it out the door, bypass a store or another DC and get it right in the end user's hand. And so that just setting aside Amazon itself, that is just an industry-wide trend. That is one of the reasons that we have 5% national vacancy in our 16 billion square foot inventory, and we saw 10% rent growth nationwide, 10% rent growth across the industrial space last year. When's the last time you said that about any product type nationwide? So it's.
Are there losers in that space? In other words, you know, older buildings, lower ceiling heights, maybe smaller format, or who wins and who loses in that? Or do those just get repurposed for other industrial demand?
Well, there's always a certain degree of functional obsolescence where you're going to take, you know, 1 or 2% off the bottom of the inventory and repurpose it into something else. But it's hard to find a lot of losers out there. There was an emerging premise prior to pandemic about the value of infill older vintage industrial properties that historically were viewed as if not functionally obsolete, Class B cheap assets. And pre-pandemic, as cities like Atlanta and Nashville and Charlotte and so forth were urbanizing, those assets started growing in value, and of course they were leased, you know, to almost full occupancy. And the question was, are these non-credit tenants that in the next downturn are going to blow up, and we're going to prove that once again they're Class C spaces? Well, in the pandemic, they didn't blow up. The occupancies held really, really firm, and then it wasn't long before we started seeing real rent growth in even those spaces. So the point is, what we thought were perennial, if not losers, just sort of laggards, have outperformed and pushed even more money back into that space. So not to wear the saw out on industrial, but
yeah. Debbie, how are we looking on time? I want to be sensitive to that. Okay, good. So we touched on, certainly before the panel here, and a little bit at the beginning with regard to diversity and inclusion. And as was noted, we are not known for that within our industry. And above that, you have a major national and really international push towards ESG initiatives, right? So how is, I think real estate was somewhat insulated from that for at the front end of that, but we understand that that's now becoming part of, it's being sort of forced into our space, whether that's through the energy piece of that, as office buildings in particular are massive hogs of energy and so forth, but maybe more specifically in diversity and inclusion. How is that bubbling up or presenting itself within your day-to-day business? Maybe I'll start with you, Marshall, and love to hear from you, Melissa, as well.
It's incredibly important. It's important to us at Blackstone. It's important to our investors. Very, very important. We take it incredibly seriously. We have a number of initiatives across the business, and thankfully it's probably a place where our scale hopefully can help us to have a real impact in many ways. So it's absolutely top of mind to us, not only in how we organize ourselves, but again, how we try to make a difference, make a positive impact. I also think as we think about investing, it's not just about doing the right thing because it's obviously the right thing to do, but I think it does inform where we invest. Again, just thinking of Atlanta as an example, the talent and the diversity in and around Georgia Tech, for example, is as impressive as anywhere we can see. And so I think there's a number of ways that it's, you know, in our minds, but I would say it's certainly top of mind to us.
Yeah.
Melissa?
So yeah, same here, incredibly important. We are looking at lots of different ways, and I know there's discussions going on at how to incent developers and owners to for green buildings, or what can we do as a large lender. We have a certain, and I don't know the percentage, but the office space or our leased space that we occupy needs to be LEED, and we have a lot of initiatives around hiring and diversity. It's interesting, when I started with the bank, and Debbie's going to hate this story, I was a member of CREW, the Commercial Real Estate Women, and which is an organization here, and I'd come back to the office and the guys would say, well, how come we don't have CREM? And I'd say, well, you do, it's NAIOP. But so today, I mean, this is incredible, and I applaud what NAIOP is doing around the diversity and bringing more diverse talent into our industry on a day-to-day basis. When we're looking at a loan on a property, what Melissa, an old person here in Atlanta, where I might live, is not where necessarily our analysts would live, and they would be like, I would never live there, and I might say the same thing, to them. So it's incredibly important to have diverse perspectives, because I mean, that's the world we live in. So they're very helpful to us in looking at loans, and oftentimes we'll bring in our analyst team and say, what do you guys think of this property? What do you like about it? What don't you like about it? And it's really interesting because the perspectives are so different.
Yeah. A lot of people, when they think about ESG and real estate, the easy thing to go to is energy, as I mentioned. But now Marshall's clients are pushing it, right? They have initiatives, and they want to know what your program is, and now tenants have their own initiatives, and they want to know that the buildings that they're going in are being thoughtful and the owners are being thoughtful. So it's kind of, you don't really realize this, but it's kind of coming from both sides in that regard. So interesting to see there. Tommy, you guys are not solely office and industrial and multifamily. You also play in some of the specialized asset types as well. Can you share a little bit about what's going on in that space, maybe biotech or other developments that you guys are looking at or doing right now?
Yeah, in terms of some of the product types we're looking at that fall into that alternative buckets, I think a spin-off of residential is the senior living space, right? There's been a demographic wave that's moving in that direction, and I think it's a timing play more than anything. And in terms of, you were talking about earlier, just are there winners and losers in certain product types? That's a space where we think that having new product is going to be extremely valuable in the next few years as we see this influx into the space. Data centers are absolutely an area you're focused on. There's a lot of dynamic there with how you operate with a utility company that can take a lot of power out of your hands as a developer. So we tentatively are stepping into that space, trying to really understand whether it can be scaled. And then in terms of the most exciting alternative asset class is life sciences or biotech. And we have a huge effort here, and the Tremble Crow team has been working on stuff in Atlanta, where hopefully Atlanta's so well poised to be exactly that for the Southeast. It's really intended to be the hub of the Southeast in terms of the universities, the access to education, the support from universities, the employment growth, the Fortune 500 companies here that can feed it. But across the country, if you look back a year and a half on the capitalization of total project budgets for Tremble Crow that were life science, it was 0. And as of today, it's close to 1.2 billion. Right. Wow. So in terms of a space, and these are big, complicated projects that can only be in certain areas. And to Marshall's point, they need to be in the right area. You can't just go and try to convert an office building that's on the periphery and expect people are going to show up. Being in the right location in the right submarket is critical to getting it right, making sure you have the support from these incubators on the outside. So there's a lot of interactions with operators. There's a lot of things that need to be considered, that these are not office buildings at the end of the day. So understanding that specialization is key.
Yeah. You mentioned Atlanta's really well poised for that, but really Raleigh has been on fire, for the last 12 to 18 months, or probably beyond before it really got on my radar screen. Stuart, I know you guys have a project on the biotech front in Raleigh. What are you seeing there, and what's been your experience so far?
Well, it's one of the first large-scale life science offerings to be put on the market here post-pandemic, so it's going to be interesting to see. We just hit the market with it, so it's not a lot I can tell you other than an immediate response. This large, a really large registration to the offering. So we're excited about it. I agree with you. I think it's one of the more exciting parts of our business moving forward. I think the entire Southeast is really well poised in this space. I think that Raleigh's gains are not at the exclusion of Atlanta. I think in a lot of respects it lifts each other. And I think you look at Atlanta and you see what we've got between the Atlanta University complex, between Georgia Tech, and and Emory. And we have the makings here in Atlanta for a life science complex that I think will be here for the rest of our careers and well beyond. I mean, it's just absolutely phenomenal,
Yeah.
Can't say enough about it.
That's great. Well, maybe now would be a good time, Debbie, to convert over to any questions that we might have from the crowd. Did you end up getting a mic? No? Okay. So any questions from the audience, and we'll try to relay if it's, and I think for those that didn't hear, massive infrastructure bill going through, what's the impact to commercial real estate, and further, is there any product type that might be particularly impacted positively or negatively? I'm not sure who may want to take that.
I saw on the news yesterday, I was watching a segment on CNBC, and you're old when you say I was watching a segment on CNBC. And it was talking about how I think there are 24 states that are going to be returning stimulus money that the federal government had given to the states, and they now have surpluses, and they're going to be writing checks to their citizens. And so California, I think it was like a $70 billion surplus. And if you make less than $100,000 a year, you're going to be getting a check for $1,000. Sounds great. It's benevolent, I get that. But one of the things that we're seeing in the industrial and in the retail space is labor shortages. And one of the reasons for the labor shortages is that, and ask anybody, I've been on 20 warehouse tours in the last 3 months where you ask the manager of the warehouse, how's your labor supply? Invariably the answer is, I can't get my employees to come in. They're getting these stimulus checks. They're spending the stimulus checks. They're just not coming to work. Now, set aside, that is not a judgment. That's just a factual observation. And the same thing is happening in retail. I was in New York the last couple of days, and one of the things you hear locally in New York anybody who's been to New York knows there's thousands of restaurants. Well, one of the reasons that a lot of them are still closed is they can't get their people to come back. So that concerns me a little bit, is that we're pushing more money back into the consumer space, and we're competing with that, I think, in a lot of ways. I don't know if you guys.
Yeah, I would agree with that. I was going to add to that just the inputs, right? We're seeing supply chain issues now that are perhaps tamping down the ability for industrial developers, for multifamily developers to build, right? It's taking longer. If you wanted to put a shovel in the ground on an industrial deal today, it's going to take 6 or 9 months longer to get steel, and so if you're now competing with the government for steel and concrete and labor, it may tamp down supply, I would imagine.
Or encourage inflation, right?
Right.
Or the other side of that, right?
Exactly.
Is when you've got a lot of demand for something scarce. So, agree. Any other thoughts before we move on?
Well, I was going to say, it's one of those classic short-term, long-term, right? It's spectacular in the long term for commercial real estate and across all product types, right? If you just make the ability to interact with real estate easier and support it by creating new avenues that can access urban cores, or to help support what's happening on the industrial side, that's only going to benefit and provide more opportunities for commercial real estate to go. Particularly, I'm going to be biased towards the development side. But I couldn't agree more on the short-term side. There is a lot of moving pieces right now in our economy that need to be pinned down before we can start seeing the challenges we're seeing on the inflation front, on the duration, the time to get wrangled back in.
Mm-hmm. Great. Next question. Come on, I know we've got one out there. You're thinking it. All right. Debbie, I think we've wrapped it up here. Guys, thank you so much. Incredible discussion. Thank you for your input and your time and your willingness.